right. Hey, everybody. Welcome to the morning market briefing Friday, May 27th, 2022. Hope you're doing well out there. We're man down. Man down. We're going to give Ben a minute to recover. Our first topic is about the market rally that we've seen a little bit. Pretty robust this morning. Dow futures up 5 points, not 5 basis points, just 5 points. We're up 0.02%. But yesterday it was spicy. I liked it. It was good for clients. We're happy to see it. But what's going on? Like, what's causing this?
I think the big narrative right now is we need inflation to come down. And there are two schools of thought. The first school of thought is that inflation is going to come down on its own. And some people who are talking about that are attributing that to wage growth may be slowing at this point. Last month in April, we were up about 5.5%. This month, we'll get the data next week, and it looks like the estimate's about 5.2%, which, by the way, is still less than CPI, which is running in the 8. So people still losing real disposable income. But the thinking is that if wage growth begins to slow, the thinking is that inflation will slow, normal service can be resumed. People are saying we've reached a level of wage inflation where employers are going to say, I've done as much as I can. And in fact, a lot of some employers are now saying, I've raised prices as much as I can as well, so I can't pay more. I've reached a limit on how much I can raise my prices. According to the Fed minutes, they said some of the contacts of people at the Fed, business owners, et cetera, was starting to report that higher prices were hurting sales. I mean, we're seeing that in just the earnings reports as well.
Yeah.
But the thinking is that and we're going to be talking about big lots later in the call, but the thinking is that prices are going to have to come down as a result. So the thinking is that inflation is beginning to slow, that we've reached a ceiling in terms of how high prices can go. It'll be interesting to see if that actually persists. We do have high oil prices. We still have a lot of these persistent inflationary impetuses in the economy, including shelter, that aren't going to come down anytime soon. Transportation, travel is not coming down right now. But the thinking is that we're beginning to see inflation crest, and that is good news as it relates to the Fed being more dovish, as well as price stability, because we need price stability in order to really grow the economy.
Yeah, and it's interesting. I was on a call yesterday with some other advisors around the country, this group I'm with. They're seeing it too. I mean, we tend to think about this, maybe in bigger companies, but these are all guys that are at firms, a little bit larger than ours. But they're kind of facing this back and forth where they're like, we can either give people raises that they think they're due, or we can hire. It's not both. Because if we do the raises, we're not going to have capital left for the hiring, which means we're going to slow growth, which is kind of this natural micro view of it. Another guy mentioned, he's like, we really need 2 people at the cost that it currently takes to get 2 people. It's just not realistic. We're probably going to hire 1, let things settle a little bit. We recognize that may hurt growth, but we're just not in a spot to really lean into that given where the market is. You're starting to see kind of the business by business response to this pricing pressure. And I think that you're going to see that across the board. I mean, this is in a service industry where, 80% of your expenses are human capital. They're not needing equipment, machinery, things like that. But even just the wage growth is putting them in a position where they have to be really smart about hiring. And I'm not criticizing any of their businesses. I mean, they're running them the right way. They're making decisions on, can we pay everybody what they want to be paid, or can we grow the staff? And we got to make that decision.
I would say, though, I am seeing that wage growth is happening in lieu of headcount growth more.
Yeah.
And I think for that reason, I do think that inflation is probably going to be stickier. So I'm not really buying into a lot of this narrative over the last week, because I do think that this wage growth is going to be coming, because at the end of the day, I think people would much rather stick with the people that they have, give them more work, pay them more. But I think that's ultimately where businesses are going. I was talking to a guy high up at a tech company, and he's seeing the same thing in software, basically saying we're in this conundrum where we have a bunch of trade-offs that we have to make. The big trade-off is, do we not try to attract people and not raise wages? Do we give people more work? How do we balance all of that? Because we can't do everything. And this is why we're seeing Microsoft slow hiring, Microsoft slow in hiring. First it was Facebook, then it was Snapchat, then it was Uber, Lyft, all these companies, Apple not making more phones, Microsoft slow in hiring. People are focused on paying their people more, but that's coming at the cost of growth, which is stagflation. I mean, that's plain and simple. That's what it is.
Yeah. I mean, this is anecdotal too, but my brother works for a startup. It was a spinoff of VMware, which just got bought out, but they gave everybody raises at the 1st of May. He got, had the meeting. They said, hey, we're bumping you up. We're going to go retroactive at the beginning of the year. And then 3 weeks later, he said, they basically said, we're going to actually push those to December, so you basically are seeing like, hey, we're giving everybody a raise. And they're like, but maybe probably not though. So not a good sign. I think it shows, the whole system is basically in that same balance, which is like, do we pay you more? Do we hire more people? Are we growing? Or are we just trying to tread water right now?
Yeah, it's a weird environment. We did see equity funds picking up some inflows this week. The best data we've seen in the last 2.5 months. Ben, as we look at that, I mean, that certainly is supportive of the narrative in terms of what we've seen with a little bit of a market rebound the last couple of days. How do you kind of digest that? What do you think the average investor is doing out there?
I think that people don't want to miss out on a rebound right now. I think that you've seen some shorts covering, and I think that people have seen a couple good earnings reports out of some companies. And importantly, we've seen companies actually go up on bad reports. Look at Snowflake yesterday. Snowflake ended up, which is wild because it was down 13% pre-market. NVIDIA had a very nice day yesterday. So we're starting to see companies actually go up on relatively bad news, and people are looking at that as a sign of a short-term bottom. And I think that they have a point. And as a result, you're starting to see a flood come back into the markets. I think that is good news, that we are starting to see people come back into the markets, but it also means that sentiment, that teeter-totter is tottering the other way now. And so we need to be aware of that and adjust accordingly and not get swept up in just how the market moved yesterday. Bank of America recommends fading rallies, but not in a rush. And I think that that's exactly the way that people should be thinking about the current environment. Acknowledge that inflation may be coming down a little bit, acknowledge that we may have seen a short-term bottom, but at the same time, don't get all on one side of the ship because we're still not out of the woods yet. We haven't even started quantitative tightening yet. That starts next week.
Yeah, June 1st.
I think that's where it puts a huge premium on. I mean, we're not talking our book, but just disciplined allocation, whether it's us, whether you're listening to this on Spotify or podcast and you have another advisor, whatever it may be. This is really a time where I think there's outperformance to be had by being disciplined. You can't have, if things are still very unknown, you don't want to just ride a 5% move in the market one way or the other. If you're going up, you want to be trimming that exposure in anticipation of potential pullback. If you're going down, you need to be buying on the way down. And I think that's just incredibly important to stay tight. If you're in a retirement fund, a target date fund, something like that, most of those funds do a pretty decent job of keeping those allocations where they're supposed to be. So that's a good thing. If that's where most of your investable assets are, I don't know that there's necessarily a whole lot you need to be doing day to day. But I think that discipline is really important. And it's also a decent time to be, just kind of layering into the market. If you're sitting on cash, I don't think this is a March 2020 situation where you just dump everything in and, everything will work out. Let's talk a little bit about earnings. I want to come to Costco last because we've kind of talking about them a lot lately, but Gap down 18%, sees EPS in the 30 to 60 cent range, as opposed to $1.85, $2.05 range. Just absolutely horrible comparative revision there. In a way, I'm surprised they're not down more than 18%, but this is a stock that's traded down, into the single digits on a price basis from $35 in the last year. Ben, anything surprising with Gap's commentary? I mean, it's pretty tough.
Yeah, Gap is just getting hit by a whole range of factors. One is macro, but number two, Old Navy, they've completely screwed the pooch on Old Navy. What they ended up doing was they're trying to have this real push for more inclusive sizing and everything. And what they found was they ended up having way too many large sizes and nothing in the middle. So they have a ton of obsolete inventory. The sales at Old Navy were down 19%. They're having to dramatically cut, do promotional on the excess inventory. And so the revenue revision was actually not all that bad. Before they were thinking down low single digits, now it's low to mid single digits. So it's only about a 2% negative revision for the fiscal year. But the margin degradation is remarkable. They were thinking 6.3 to 6.8% operating margins for the year. Now they think 1.8 to 2.8. So boom, cut by 2/3, barely profitable. So Gap is just, so Gap owns Banana Republic, Gap obviously, and Old Navy, and Old Navy really just hitting the business so hard, which is a shame, because Old Navy had been the star performer for Gap for a number of years, and in the last few years, it's really went from one extreme to the other.
Big Lots, kind of a perfect storm there in a very bad way as well. This is not a recipe for success. If your revenue comes in lower than expected, your margin undershoots by close to 10% of what was expected, your inventory grows almost 50% above what was expected, you're going to have a tough quarter. And they actually lost 39 cents in earnings this quarter. The expectation was that they would make 99 cents. So just an absolutely horrendous quarter. Stock was down as much as 20%. It's rebounded a little bit. I think it's down like 14-15%. But I think what's interesting to me is some of these lower end retailers that you think might actually deliver in this challenging environment. We're seeing a real mixed bag in terms of results. I mean, we've seen TJ Maxx do pretty well.
Dollar Tree,
yeah. So we've seen some do well, but we've seen others just, absolutely take it on the chin. And Big Lots is certainly in that category. Just rough.
I mean, Big Lots is the Kmart of Kmarts. So you can't imagine they're drawing the best talent at the manager level. I mean, it's been a dying store for as long as I can remember.
And they're cutting prices like crazy right now. They said that trends slowed materially in April, resulting in a need to increase markdowns, and they're going to get incredibly aggressive, quote, right sizing the inventories over the course of the next quarter. So this means if you want a deal, go to Big Lots.
This is not at all relevant, but they used to do Christmas commercials with Mikey, the Big Lots elf. And people may not know this, but Mikey went to Roswell High and his brother was in my class. He was a big celeb. No big deal.
He was a Hornet.
Yeah. Rest in peace, though. He did pass away relatively recently, but for a long time, he was the face of Big Lots commercials. Not to brag about my alma mater.
Yeah. I mean, come for the analysis, stay for the name dropping.
Yeah. He was also in the movie Black Knight with Paris Hilton and Martin. I can't remember Martin, but Martin Lawrence.
All right. There we go. Natural segue here. Speaking of Costco, Costco down just a little bit. Ben, you really liked their call. Talk to us about what's going on with Costco. I mean, they had a great day yesterday, up close to 6%. Right now, they're down about 1.5% after their earnings report, which honestly, the way things have gone, if you're down 1.5%, that's pretty darn good. What were they saying that you liked?
Yeah, especially compared to something like Target or Walmart. Yeah. They're basically saying that they have a tremendous business that didn't really see much change at all throughout the course of the quarter. Their margin profile at the end of April looked just like it did at the beginning of the quarter. It looks just like it does now. Their gross margin was a little bit lower than some people had wanted, but that's just because last year on their fresh foods, they had pretty much zero spoilage because people were just buying their fresh foods like crazy. And now it's a little bit more normal. So I'm not really concerned about that at all. The membership just continues to grow. Their households were up 6.5%. Their executive members were up almost 12%. Retention rates at all-time highs, renewal rates at all-time highs. They're passing on some inflation, but still giving really good value. They're able to have, because they have a limited number of SKUs, a limited number of products that they sell, they're able to really get good pricing on some of that. So they said, inflation continues. In fiscal first quarter, it was about 5%. Fiscal second quarter was 6%, and this last quarter was about 7%. But they continue to hold their own, and apparel, appliances, TVs, and even furniture haven't been a lot of trade downs. And they're not raising membership fees yet. So last membership fee increase came in June 2017. They typically raise every 5 to 6 years. This would obviously be year 5, but they're looking at that, and I wouldn't be surprised to see an announcement in the next 12 months. And I think it's just steady as she goes. Very good business. They're getting good traffic. They're getting increased traffic per store, and I like where things stand with them.
All right, we're gonna wrap it up there, unless anybody's got any closing week comments. Futures kind of ramped up while we were talking. Dow futures up 26 basis points. S&P futures up 0.5%. NASDAQ futures up close to 1%. So hopefully another nice green day. Feels like a very different vibe than last week, where it felt like nobody wanted to own anything going into the weekend. We do have a long weekend coming up, so there could be some volatility. As I would guess kind of early in the day. I think a lot of people will cut out early, but we'll see what happens, and we'll talk to you guys on Tuesday morning. No call on Monday, Tuesday morning.